Have you ever looked at how some people build just incredible wealth and it feels like it came out of nowhere? Well, it usually comes down to one of the most powerful, yet kind of simple, forces in all of finance. And today, we're going to pull back the curtain and show you exactly what it is.
All right, let's just dive right in, because what I'm about to show you, well, it might not seem real at first.
Seriously, just let that question sink in for a second. You put in $250,000 over 2 whole decades, and somehow it balloons to nearly $4 million bucks? How in the world is that even possible?
And here it is. This is the proof. You see that little blue bar at the bottom? That's your money. That's the $240,000 you put in. Now look at that massive orange bar sitting on top of it. That is all growth. Just look at the Apple investment. Your contribution is completely dwarfed by over $3.5 million in growth. It's not magic. It's just math.
So here's the kicker. This kind of insane result, it doesn't come from being some kind of stock-picking genius or trying to perfectly time every little market dip and peak. Nope. It comes from just one single, powerful financial principle. And that principle? It has a name. It's the engine that was driving all of that crazy growth we just saw. So let's break down what it actually is. The simplest way to think about it is interest on interest. See, your money starts to earn interest, but then the interest you just earned also starts earning its own interest. It's like your money is having babies, and then those babies grow up and start having their own babies. It sounds simple, but the effect over time is just profound. And to really get it, let's put it side by side with its less powerful cousin, simple interest. With simple interest, you only ever earn interest on the money you first put in. That's it. But with compounding, you're earning interest on a pile of cash that's getting bigger and bigger and bigger all the time. This little table shows it all. Look, in year 1, they're identical. No difference. But then look at year 2. The compound account has already earned an extra $2.50. Why? Because it earned interest on that first 50 bucks of interest. By year 3, the gap gets even wider. Now, I know it seems tiny right now, but this is how the avalanche starts. So let's see what happens when you keep that going. When you add consistent monthly contributions to this accelerating effect, you basically create a financial snowball that just gets bigger and picks up speed as it rolls downhill. Okay, so check out this 10-year breakdown. You're putting in $1,000 a month. In year 1, you make about $650 in interest. Cool. But fast forward to year 10, in that 1 year, you earn over $17,000 in interest. That's way more than the $12,000 you actually put in that year. And it's all because the interest is being calculated on a much bigger balance that includes all your past earnings. That's pretty amazing, right? But what if we could pour a little more gas on the fire? What happens if we manage to double that monthly contribution? Now, common sense might tell you, hey, double the investment, you double the interest. But look at this. That's not what happens at all. It more than doubles it. The total interest you earn jumps from around $81,000 to over $171,000. That, right there, is the exponential power of compounding. The more you feed it, the harder it works. But of all the different factors, how much you invest, what kind of return you get, there is one that is more powerful than anything else. And that superpower is time. I absolutely love this quote from Brian Feroldi because it messes with your brain in the best possible way. How can $100,000 be a quarter of the way to $1 million? It just doesn't sound right. But it is. Because at that point, your money is doing so much of the heavy lifting for you that the next milestones just start coming faster and faster. Getting that first 100K is by far the hardest part. And to really, really drive this home, let's look at a scenario. We've got 2 investors. They do everything the same, except one of them has a 15-year head start. Okay, so after 15 years, our first investor has built up a really nice portfolio, right? Over $500,000. That's a huge achievement. But look what happens to the investor who had an extra 15 years for that money to just sit there and compound. The portfolio didn't double, no, it more than tripled, soaring past $1.7 million. That is the unbelievable, almost unfair power of time. So knowing all this is great, but what do you actually do with this information? Well, it really just boils down to a pretty simple 3-step plan. First, and this is the big one, start as early as you possibly can. We just saw why. Time is your single greatest asset.
Second, make sure you're automatically reinvesting all your earnings. You want every penny you make to start working for you immediately. And third, manage your risk. Compounding is like a train. It needs to stay on the tracks. Big losses can derail the whole thing and set you back years. So diversification is absolutely key.
You know, that journey to your first big milestone, that first $100,000, it's going to be the slowest. It takes the most work, the most discipline. But once you cross that line, the magic really starts to happen, and the power of compounding truly begins to take over. So the real question is, are you ready to start that journey and let your money finally start doing the heavy lifting for you?